Good morning, everyone. Jay Del Rio appreciates your participation and welcomes you to the webinar, Tax Treatment for Stock Options in Mexico. It is my pleasure to introduce our speakers today. We have Tania Salinas, Tax Manager in our Mexico City office, and Rolando Diaz, our Labor Senior Director in our Guadalajara office. Let me give you a little background of our speakers. Well, Rolando graduated from the University of Guadalajara with a degree in business administration. He has a diploma in senior management from the Instituto Tecnológico de Monterrey, and he specialized in managing payrolls for foreign employees and implementing mural payroll schemes for expatriates. He's currently the labor director in J. Del Rio, and with more than 20 years of extensive experience in salary structuring, payroll management, and social security of international companies established in Mexico, mainly for the manufacturing service and software development sectors. And Tania, she has more than 80 years of experience in expatriate service, reviewing and implementing international payroll schemes and performing tax risk determination analysis, as well as reviewing multinational benefits. She has been in charge of the tax compliance and tax consultant of international company, and she also specialized in the analysis of the tax situation of international companies and their Mexican subsidiaries. Now, I'll give the microphones to our speakers so they can start this webinar. Thank you.
Thank you, Alejandra, and hello, good morning. We are very glad to present this webinar. We really appreciate your attendance. My name is Rolando Diaz. I'm Labor Senior Director, and I'll be starting with this relevant topic, tax treatment for stock options in Mexico. So let's get on the agenda for today. First, we are going to explain the compensation concept, which applies to Mexico. It is not very different from other countries. However, I think a brief explanation will help to understand better how the different components of compensation are integrated in Mexico. After that, we are going to explain the stock options concept and its classifications. We will also describe the advantages of granting this benefit to the employees, and in addition, we will explain the tax effects for both employers and employees, and finally, other important considerations. So let's get it started. Next slide, please. Well, the compensation definition may be massive. It can include several kinds of payments, including money, goods, services. We can also name fringe benefits such as medical or life insurance, savings fund, food coupons, and similar concepts which are very common in Mexico. For payroll purposes, compensations, if we can define that concept, refers to the monetary payment given to an individual in exchange for their services. Even this definition is somehow defined in our federal labor law. So speaking of money payments, we can classify them in 4 different categories. The first one will be the wages. Then we have long-term incentives, and in this category, actually, the stock options are included. We also have short-term incentives and the benefits. Wages are usually the main component of compensation. It usually contains 70 or 80% of total revenue of an employee. It is also usually a fixed amount, and it rarely changes during a year, unless obviously the employee gets a promotion. Short-term incentive refer to the hours given to the employees in a time period of up to 1 year, It can be a quarterly bonus or an annual bonus. Short-term incentives are typically tied to contributions that have the greatest impact on company performance and are used to inspire goal achievement. For benefits, we have like two main categories. Mandatory benefits, which are obligated in Mexico, such as the Christmas bonus payment and the vacation premium, and fringe benefits, which are optional. For the long-term incentive, we can say that are a form of variable compensation that is earned and in the present, but whose payment is deferred and spread over time. A good example of a long-term incentive is the US 401k benefit, a seniority award for 5, 10, or more years of employment, and of course, the type of share that we are going to explain in this webinar. But why do we need to implement long-term incentives? Basically, we want to implement these to create milestone-based enticements to involve employees in the value creation for the company and to encourage employees to stay within the company. Nowadays, it is a challenge for companies to keep their talent, and long-term incentives, we think, can influence the permanency of our workforce. For the long-term incentive payments, normally transnational companies guarantee incentive plans for their employees, which includes stock options, the option of purchase of shares at a reduced value, obtaining shares for free, and the payment through a compensation deferral for those shares. So to understand the different types of shares provided to the employees, my colleague Tania Salinas is going to explain to us each one of them. Please, Tania, go ahead with the next slide.
Thank you, Rolando. Good morning, everybody. Okay, as Rolando mentioned before, one of the long-term incentives are the stock options. These are a type of equity compensation given by corporations to some employees in the form of an option to buy shares of the company at a discount or at a fixed price. I will explain this type of scheme. First, the stock options. This is the most common equity compensation scheme, and once employees complete a certain time in the company and or reach an imposed goal, it gives them the right to buy shares at a specific price, usually with a discount. The second one are restricted stock units or RSUs. These are other way an employer grants company shares to employees, as this scheme allows them to acquire the shares but at no cost, meaning employees receive the net amount of the granting shares. This grant is restricted because it is subject to a vesting schedule, which can be based on length of employment or on performance goals, such as stock options. Actually, the difference between the stock options and the RSUs is that in stock options, the employee has the option to buy shares at a discount, while in the RSUs, the shares are granted at no cost. Third, we have stock appreciation rights, or SARs. This gives the participant the right to receive appreciation in the value of the employer's stock from the grant date to the exercise date. The valuation of a SAR operates exactly like a stock option, in that employees benefit from any increases in the stock price above the price set in the grant. However, unlike an option, employees are not required to pay an exercise price, but simply receive the net amount of the increase in the stock price, in either cash or shares of company stock, depending on plan rules. The fourth are the phantom stock. This plan gives employees many of the benefits of stock ownership without actually giving them any company stock. Rather than getting physical stock, employees receive mock stock. Even though it's not real, the phantom stock follows the price movement of the company's actual stock, paying out any resulting profits. In these last two schemes, employees do not obtain any shares. they do receive the benefits of owning them. And finally, matching shares. The matching shares give employees one additional share for each share they wish to buy. The share to be acquired is granted at market value. However, an additional share will be granted for free or free of charge after a certain period. Okay, in the last slide, I spoke about some basic concepts which are indispensable to understand the concept of the stock options. Okay, first is the grant. The grant is the moment where the employers offers the stock option plans. In this moment, it's only an offering. It's not it doesn't have any tax implication. The right to acquire shares of the company is granted once the restrictions are released. Now, Ale, can you go back, please? Vesting period. It is a period of time that is established to be able to exercise the purchase option of the shares, or also can be considered as the process by which employees access right of the shares, which give them an incentive to carry out their work and remain with the company. Exercise is when employees can exercise the option to purchase the shares or acquire full right to sell them. In other words, is the moment when they can decide whether or not to buy the shares, or the moment when they obtain the benefits. And finally, we have the sale moment. In this moment, the employee already owns the shares and decides to sell them in the market. And in this time, the company does not have any implication. Okay, the advantage for the employees. You may be asking, why should I give my employees this kind of long-term incentives? So now I'm bringing up some advantages the company may obtain by implementing this type of long-term incentive. This can be that it improves the remuneration conditions of the staff without reducing the liquidity of the company, since it does not involve any financial outlay. The employees acquire an incentive that will be aligned with the interest of the entity and therefore of the shareholders. Boosts employees' job satisfaction and financial well-being by providing lucrative financial incentives. Employees act like owners, so therefore they will take better care of the company and its finances. Incentivizes employees to help the company grow and succeed because they can share in success. Talented employees are retained as it encourages permanence and rooting. It is a key tool to recruit the best and the brightest. The employee has a greater benefit when the market value of the share increases.
Okay, so well, we are going to play now which is the taxes effect for both employees and employers. And in the next slide, we will see from the employee perspective. The Mexican income tax law was revised in 2005 in order to include as taxable income the option granted by the employers to acquire shares at no cost or at a price lesser than or equal to the market value. It doesn't matter if those shares have been issued by the employer or by a party in a relationship with the employer, which in this case would be the parent company, probably in the US or another foreigner country. Therefore, the procedure to determine the federal income tax would be the same as determining the tax for the employee's wages. The tax rate will depend on the whole revenue for the corresponding month when the employee opts to exercise the stocks. That's very important because it is often confused if we should accrue the income when the shares are granted, but actually the correct time to tax is when the employee exercises the stock options. So in the next slide, we can conclude that the cumulative income would be the difference amount between the market value of the shares at the moment of exercising the option versus the price established when the option to buy share is granted. As an example, if an employee exercises one share with a current value of $10, but the price defined when the option was granted was $5, the taxable income for the employee will be the difference, $5. That's the way it works in order to accrue the taxable base for the employee. And another important consideration that we can see in the next slide that we need to take care of is the option procedure described in the rulebook of the income tax law, which allows us to reduce the cumulative income of the exercised shares by decreasing the premium paid for holding the option to purchase them. In addition, this amount can also be updated with the inflation rate. Now it's Tania's turn to elaborate in another tax implications.
Okay, I will elaborate on the income tax in other countries and how to avoid double taxation. Sometimes, even if the employee works for a Mexican company, the shares granted belong to the related party abroad. In these cases, the employee may pay taxes on the income abroad, and a double taxation that affects the net benefit of the employee may arise. However, the Mexican income tax law in its Article 5 establishes that Mexican tax residents may apply the income tax paid abroad on foreign income sourced as credit to the tax payable according to the legislation in force. It is important to say that this application as credit shall only be in order when income tax paid abroad is included in the revenue obtained or earned as taxable. Okay. We have already explained the tax implications for employees, but what happens with employers? The employer that grants the option to acquire shares will have to calculate, withhold, and pay the corresponding income tax for the exercise of the option on behalf of the employee. Also, will have the obligation to issue a payroll digital tax receipt by internet, where it states the amount of the income received by the employee and the income tax withheld. The employer must submit before the tax authorities a notice to provide information on persons who choose to acquire shares or security at no cost or a price less than or equal to the market price, which is the notice number 51/ISR, and this must be submitted no later than February 15th of the following year.
And I think that it is important also to consider that any variation of the share granted to the employees is subject to the state tax on payroll, and the taxable amount will be part of the Social Security salary used to determine the corresponding contributions. The state tax on payroll is an employer tax, and as explained in this chart, the rate can go up to 3% of the total payroll concept paid.
Thank you. Now let's talk about the deducibility of the equity compensation. The company is allowed to deduct this compensation through payroll if the payment is considered as strictly indispensable, it is booked in the accounting as provision, if the employer withholds and pays the tax of the income to the corresponding authorities on behalf of the employee, as we mentioned in the last slide, and if it is actually paid by the Mexican entity, or if it is paid by the third party abroad, the amount must be charged to the Mexican company. Okay, here are some recommendations for the employers. Before, while speaking how the employee can avoid a double taxation, I said that sometimes the shares are paid from the third party abroad. When this happens, there are two ways for the companies to proceed, with a charge from abroad to the Mexican entity or with no charge. Here are some recommendations for each. First, when the foreign company charges the Mexican entity, it must exist a secondment agreement between both companies, which states that the respective charge is due to a reimbursement that the Mexican company is making for a payment made on its behalf. Second, to have the inventory of the personnel who participate in the share plan, containing their individual information and the number of shares and amount. And third, to obtain the invoices through which the foreign company intends to fully or partially recover the amount of the benefit received by the employee. When the foreign company does not charge the Mexican entity, the suggestion is to keep an eye on the employee, as the responsibility for paying the taxes will remain on them. In this case, the employee will have the obligation to file monthly tax return assimilating their income to salaries and make the tax payment no later than the 17th of the following month after exercising the option. We will speak about other considerations to bear in mind. Sell to cover. As we could see, not in all cases the income obtained is in cash. The workers may end up not having sufficient funds to cover the total cost of the shares exercised, as well as the tax that is generated. Given this case, the employee can choose to sell sufficient stock acquired to cover the total exercise cost of the remaining shares. For example, an employee might exercise options for 800 shares at a cost of $30 per share when the market price of the stock is $60. The employee would sell 400 shares at the market price to cover the cost of the remaining 400 shares. The tax implications at sale. Okay, employees may sell their acquired shares, and sometimes they do it right away to purchase, and sometimes they keep them and wait for them to gain value to sell. In both cases, at the time of sale, another taxable income arises, and it is important to consider that taxes must be paid. These taxes will be determined considering the sale price, the updated purchase cost, and the time the shares were owned. If a profit is determined, it will be subject to taxation up to 35%. If a tax loss is determined, this can be decreased from other type of income obtained by the employee, except from salaries and business activities. This tax must be paid by the owner of the shares, the one who is selling them. Therefore, the company does not have any tax implication in this point. Finally, here are other actions to be considered once employers decide to grant shares. First, to gather all the support information of the transaction. Second, to confirm which entity is paying for the LTI and who is responsible for paying the taxes, if the employee or the employer. And if the company will cover the tax payment, do not forget to gross up the income amount. Third, to confirm the tax residency of the employee at the moment of the exercise of the option. And finally, to confirm if the tax payment must be made through payroll withholding or a monthly tax return. Thank you for your attention. I'm going to pass up the microphone to my colleague Alejandra.
Okay, thank you very much, everyone. Well, now it's time for our Q&A session. And let me tell you something. If by the end of this blog, there is still an answer question, don't worry, we will contact you as soon as possible with the answers, okay? And we continue invite you to send us all of the questions that you will have. All right, there's the first question. Please help me, Rolando or Tanya, to answer them, okay? It says, when the shares are paid from abroad with no change to the Mexican entity, does the employee need to file an annual tax return? Who can help me with that one?
I can answer that, Ali. Thank you. No, it really not depends on where the income is paid, as it is considered as a salary income. So therefore, if the employee earns more than 400K on salaries per year, the employee has the obligation to file an annual tax return.
Okay, thank you very much, Tanya. Okay, we have another one. It says, can an employee pay on his own the taxes if he opts to exercise the stock options? Rolando?
Okay, I can take that. The answer is yes, if the parent company does not transfer the cost to the Mexican subsidiary. In that case, the employee is obligated to pay on his own. Otherwise, the employer is obligated to withhold and pay the income tax on the employee's behalf. However, remember that if the employee sells the shares, he will be obligated to inform and pay the taxes by himself too. And my recommendation for this kind of situation is that once we decide to grant stock options, inform to the employees that that is a taxable income, and somehow the employee or the employer has to pay the taxes. Because it is common that some employees think that the stock options are not taxable, and they are. So that's also a recommendation. And be aware that if you have, let's say, the option to exercise on each January, inform the employees previously so they can be ready to pay the taxes, because the taxes will be deducted from the actual salaries, not from the stock options, because there's no way to directly discount taxes on an asset such as a share. So that will be also my recommendation.
Thank you very much, Rolando. Okay, there is another one. It says, do the stock options must be considered in the profit sharing calculation?
Okay, Ali, I can take this.
Thank you.
Yes, the stock options must be considered in the profit sharing calculation if the Mexican entity is charged, or if it pays directly the stock options to the employee, because in that way it must be considered as part of the payroll of the employee. Otherwise, if the payment is from abroad, is from the third party abroad, and there is no charge to the Mexican entity, then it must not be part of the profit sharing calculation. It depends on that.
Okay, thank you very much, Tania. And well, we have one last. It says, can an ex-employee request to exercise his granted stock options? Rolando, Tania, who can help me with that one?
I can take that.
Thank you.
Not really. Usually the stock option plans do not consider that an ex-employee has the right to buy shares. It is a benefit for current employees. If an employee resigns, it is no longer part of the plan. However, it is common that an ex-employee could sell his shares to the company and obtain the corresponding payment. But let's say that those would be those shares, some shares previously acquired by the employee, not the ones that are going to be exercised. So that's why we implement a stock option plan. We want to keep the talent, and they need to be in the payroll, being current employees in order to take the benefit.
Thank you very much, Rolando. We have another one. It says like this. Are there exemptions to these requirements for private companies or small shareholders in Mexico schemes? Who can help me with that one?
I can, Ale.
Thank you.
No, unfortunately, there are not exemptions. I mean, these requirements must be met completely, because otherwise the payroll deduction is at risk. So it's that important to fill the requirements. Even if it is only one shareholder, it's super important to have all the gathered information to pay the taxes on behalf of the employee when the case applies. I mean, when there is a charge or the payment is coming from the Mexican entity, to have this secondment agreement. Those are the basic requirements to pay this type of long-term incentives.
Okay, thank you very much. Thank you very much, Tania. And And the last one, I believe, it says, in our company, stock options are granted by the US company. Also, the management of the stock is provided by a third party. Actually, that third party paid to the employees with an abroad transfer, and the employee is responsible to pay taxes. Is this process correct? A client asked that, actually.
Yes, I can also answer that.
Okay.
Yes, this process is correct. Since there is no a charge from the company abroad to the Mexican entity, the Mexican entity does not have any control on the payroll or on the withholdings. So the entity abroad pays directly this amount to the employee in Mexico, to the Mexican bank account, and the employee must file a monthly tax return as salary income, and also must file an annual tax return on this for this income.
Thank you very much, Tanya. Okay, there are comments on another ones. Okay, it says, do we need a recharge agreement between the US company that the company is issuing this agreement?
Yes.
Sorry, let me, okay, go ahead, Tanya, thank you very much.
Yes, Ale, you need a secondment agreement. This secondment agreement is a contract between the related parties, one abroad, one in Mexico. And in this secondment agreement, it states why is the company abroad paying for this benefit, employees' benefits. So yes, this is a must that the companies need to have.
Okay, thank you very much. Let me see if we have another one. Okay. Just give me 1 second. It says, I represent a US company with a Mexican subsidiary that is not set up for an employee entity, equity. Is phantom stock a popular option for LTI?
No, it is not the most popular option. The most popular option are stock options, but with the phantom stock, besides that the liquidity of the company is not affected, it's not affected the stock of shares either, because you are not providing any type of shares. You are providing only the benefit of having a share. I mean, this is really interesting. I cannot profundize in this subject very much because of the time, but I can answer you a complete answer by email later.
And I would like to add that that would be like any bonus. I mean, the payment should be treated like a performance bonus, and in that option, there's no shares paid to the employees, but just the monetary amount.
Thank you very much, Daniel Rolando. And the last one. Why do you think it's very uncommon to have this LTI in Mexico?
Oh, because the employers do not know about this type of schemes. It is pretty common on international or transnational companies, because we have the example of the companies abroad, especially if they come from US, Canada, Europe. In Mexico, I only know 2 companies that, in Mexico, for Mexican companies, I only know 2 of them that provides or grants this type of incentive. But I think that it's something that we need to start publishing or letting the employers know, because it's a really good long-term incentive.
Okay.
And I think that it is also because the origin of the stock option was in the .com companies back in probably at the beginning of this century, and it was like a fashion on those days, and probably those are not very known for the Mexican entities, and that's why, as Tania mentioned, some or most employers, Mexican-based, are not paying these kind of benefits.
Okay. Well, thank you very much, Tania and Rolando. Definitely, if there are any other question, we will definitely come back to you with the answers to your questions, okay? And well, we have reached the end of this webinar, and J Del Rio appreciates your interest and remains at your disposal for any other question that you will have. Thank you very much to all of you, and have a really good day.
Thank you.